Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to goldradio.fm. Available online at housestreet.com, talkdigitalnetwork.com. Welcome to goldradio.fm, podcasting in 0.99995. I'm Jim Goddard. My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Hi, Jim. It's Friday, but we've got a special list of questions.
Yes. What has been the history of gold markets?
Well, gold has been money going way back. The first coins began in Greece. Was that 700 BC, something like that? So the public decided that gold made a very good form of money. And then also silver has been a form of money. So there's been a gold market, let's say forever. And even in 1861, when President Lincoln went off the gold standard and started printing greenbacks, in an instant, traders had rented a room in Wall Street and started trading greenbacks at a discount to the gold dollars. And Lincoln even lost his temper on that one. So gold as a monetary item has been around by choice for a long time, and there's always been a market for it.
Why has gold been a store of value throughout history?
Because the public decided. It happens to be a very useful metal. It is dense, it is malleable, and it has a lovely color, and the public decided that it was a store of value. And there have been any number of intellectual economists over the decades who have railed against it, but those that rail against gold don't understand it.
Does the financial system still consider gold to be a store of wealth?
Well, on the let's call it on the gold sympathetic side, yes. One of the things we've been thinking about is that as in a post-bubble environment, the real price of gold goes up, and the central bankers are really nothing more than a bunch of sheep. So as gold becomes more attractive with the real price going up, they'll be then deciding that gold will be a good reserve in their banks, in their central banks. And this is happening. There are a number of central banks who are buying gold, and I think it will continue.
What is the real price of gold?
That's always a good one, and it's also the real price of money, because the real price is the way we do it, is where you take the price of gold in the senior currency and adjust it for the rate of inflation. And that's the real price. And it is also quite even more simply described as being how much can gold buy. And what happens is that the price of things change, and also the purchasing power of gold itself changes. It's not constant, but it's a fascinating subject.
The coronavirus is being called the black swan. How does gold react during black swan events?
Often on a sudden event like a outbreak of hostilities in important countries and stuff like that, you'll get a spike up in gold, and our technical work on that is always pretty good. You watch for the excess when it happens, but this has been around for a long time. The coronavirus, you can call it a black swan, but the reaction in the financial markets is less of a black swan and more natural to the end of a big speculation which occurred in January. So,
is the gold market manipulated to the upside and the downside?
Oh yeah, this is a favorite, Jim, because the gold bugs they're living in the 1970s when the Fed was bad and the dollar was going down and gold went up and it's inflation and all that sort of stuff. But not understanding that in another decade the public will decide to speculate in financial assets, which has been the deal lately. But I have found that when a ardent gold or silver analyst misses on a forecast, the immediate thing is it's a conspiracy that somebody in government has gone out of their way to make sure their forecast doesn't work. But the problem with the usual gold bug is that they strictly go on supply and demand, and they've got this special information on how much is around and how much buying, and then they go to price. But there's only one way to forecast the price and the direction of gold, and that's to look at financial history and work it all out.
We'll have more with Bob Hoye right after this.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to goldradio.fm. Available online at housestreet.com, talkdigitalnetwork.com. Welcome back. We're chatting with Bob Hoye. Bob, with government spending billions, even trillions of dollars to prop up economies around the planet, should gold be moving much higher?
Well, that's one of the theories. Again, that ties to the old story about central bank depreciating the currency, and that would especially favor gold. But no, there's no link between the amount of currency credit being issued by a central bank and what gold should be doing. The best thing as we do is just go to the real price of gold and understand that it goes up in a post-bubble contraction, no matter what governments will be doing with issuing trillions and trillions of credit. So it's not a clear-cut link there. It's best just to straight analyze the price of gold and avoid cause and effect things.
How does a credit contraction affect gold?
Oh, yeah, there we are, because a contraction, of course, by definition, comes in after a credit expansion, and the credit expansion is always huge against a financial bubble, which we have been in. And they gain history then, where we took and figured out the real price of gold during a great financial bubble, and the real price has gone down, which it has done. Actually, the last high for the real price of gold was at the bubble of the gold mania in 2011, and then it definitely came down. But then, one of the very reliable features of at the end of a great bubble is gold turning up. So gold's real price set a key low in 2018 and has been moving up. It's quite strong, which is increasing the profitability of gold mining. So, I think the mechanism on the contraction is that in nervous markets, the careful money goes to the most liquid items. And the most liquid items are gold and U.S. Treasury bills, stuff shorter than 1 year notes. So this is where then this puts in a very good bid for gold and also puts in a good bid for the dollar. So again, we come back to the real price of gold, which has been improving, and it also is improving operating margins for the gold miners.
We're hearing some gold mines were shut down due to the coronavirus. Are we likely to see a shortage of gold in the short term?
No, I don't think so. There could be some loss of production, but with the price of gold being so attractive, there will be operations that can be expanded, the rate of production. So, I don't see that as a major factor.
We'll have more with Bob Hoye right after this.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
You're listening to goldradio.fm. Available online at HowStreet.com, TalkDigitalNetwork.com. Welcome back. We're chatting with Bob Hoye. Bob, is gold still an inflation hedge?
Yeah, it is both a hedge against inflation and deflation. But that, again, a hedge against inflation is the old 1970s story. And we're going into a period of deflation, and this is the irony when gold becomes more and more attractive. So, yeah.
Do you see any currencies being backed by gold?
Oh, none now, but I think the world has suffered another great experiment in authoritarian government, and these in the past have run and until there's no more money left and until the bureaucracies have ruined the economy. So there's a reform movement going on against this. So they're going to, in popular uprisings, they're going to reform big and uncontrollable government. And also, the thing that has helped finance governments has been, beyond confiscatory taxation, there has been depreciation, deliberate depreciation of the current currency, which is a state theft. And the public will move against that. So I can see eventually the public forcing each of their governments to have a currency that is convertible into gold. So there would be, well, of course, the best thing would have the senior currency convertible, which is the U.S. dollar. I believe it'll happen.
What are your thoughts on gold bullion, coins, ETFs, top tier, mid-tier, and junior gold stocks?
Well, I think the bullion and the coins you would have, in your vault, so to speak, as insurance. And then ETFs are good, like GDXJ. It's a good way to participate in gold equities. But the best place to be is not to make money is not long bullion or gold futures, but to be investing in gold stocks, because there's where the value added will be done, and and it will also affect all. You're going to the majors where their production will be enhanced by price of bullion being attractive relative to their costs of mining. But then also you have the valuation of exploration properties with the real price going up for gold. That enhances the valuation of a mineral deposit. So the action will also be in the junior exploration stocks, and this is the sector that I really like, is that maybe, we're already in the new bull market for gold stocks, and all sectors have moved, but the way I play it is like position the GDXJ, because it moves nicely, and then select some favorites within an exploration group with some brokers or analysts who know what they're doing. We're not prepared to make a list of juniors, but at any rate, the action for an exploration at times will be outstanding.
When it comes time to sell gold, which instruments are the easiest to sell? Bullion, coins, ETFs, top tier, mid tier, and junior gold stocks?
I think for the average investor, they're all liquid enough. You can move quite quickly on any of those. So they're all immediately executable. So yeah.
How could Bitcoin go to $20,000 while gold has yet to hit $2,000?
Yeah, Bitcoin was one of the most remarkable bubbles in history. Huge and fabulous gain. And technically, a couple of swings in there. Our technical research got the swings very well, including, I think it was December 17th, 2017, which was the ultimate peak, and we got a very big sequential sell on the Bitcoin then, and then of course it all collapsed. So, but then there's no relation between a Bitcoin and gold. So, but it's a fun question to look at the numbers of 20,000 on Bitcoin and then gold yet not making it to 2,000. But with the real price probably heading up for many, many years, you're going to end up with a speculative market for gold stocks that could be the equivalent of gold going to 20,000, but it'll be done through the real price. But it doesn't matter whether the dollar price of gold goes to 10,000 or 5,000 or whatever. If the real price is going up for a long time, it will build a huge speculative play in the gold stocks. So I'm looking forward to it.
Back in the 1930s, the U.S. government confiscated gold except for jewelry. Is gold confiscation a concern now?
I don't think so. I think the popular uprising and the Tea Party and the criticism of big government is becoming too powerful. That confiscation of gold by the Roosevelt government in 1933 was very radical stuff. They were quite experimental with the New Deal, and they had come across a professor of agricultural economics. I think his name was Wallace, and he sort of joined they called it the brain team or something like that, and he had this idea that if you raised the price of gold, it would also raise the price of grains. And in the early 1930s, the farmers were suffering very weak prices, but that was a unfounded theory, and so the way to make it work was they wanted the price of gold up, like depreciate the dollar relative to gold, because It started when gold was at $20.67 an ounce, and then they got tired of the experiment when it got to 35, but it really didn't do anything for agricultural prices, so it was a strange experiment. But also, they didn't want to see the people, the moneyed people, make money on this experiment. So that's why they acted unconstitutionally and confiscated gold. I don't see it happening again. That was an extraordinary event.
Is there a correlation over time between the price of gold and the price of real estate?
Hey, that's a good question, and I think I can answer it with following the 1873 bubble, which was huge. And the only chart I could find on real estate over a long period of time was in England, and it was farmland values on that depression from 1873 to 1895, and the index, the chart of farmland values, declined every year for the 20-plus years, and so real estate was a disaster. And at the same time, the real price of gold was going up, so gold mining became very profitable. And so I think that answers that question. There's it's an inverse correlation, because in a Great Depression, real estate goes down and the price of gold goes up.
How is gold doing in the U.S. dollar compared to other currencies?
Well, it's rallied. Our technical work has been very good on getting the rallies on this thing, and of course, the dollar has been firm relative to most currencies, and in which case the gold in lesser currencies has been terrific. You've made money on that. But this new world, Jim, it's not going to be U.S. dollar down and inflation up. It's going to be the real price of gold going up and a bull market for gold stocks. Actually, as I said in one of the questions above, I prefer the stock market side of the gold opportunities.
Do gold markets tend to give off technical entry and exit points?
Oh, yeah. Yeah, very good. The technicals we get on either the gold price in Canadian dollars or U.S. dollars or any of the stocks has been reliable. They give really good signals on exits and entry points, and our subscribers benefit from them.
Is the gold-silver ratio a good indicator for gold?
Oh, yeah, but we use it in a different way. Most of the silver bugs are just look at supply and demand, and they always see a shortage each year of supply. The demand and the consumption of silver is greater than its supply, and they use that to hypothecate that silver is going to go up. But gold, both of these are financial items, and gold is the ultimate money, and silver is something else again. So I'll show you how we do it, and we take it the other way around. The silver-gold ratio on any bull market for precious metals, silver, of course, rallies faster than gold does. And in going back to 2011, at that speculative peak, we had known for decades that when the silver-gold ratio gets too strong, and we use a momentum thing on that, the weekly RSI, and whenever it gets into, say, 85, the speculation is becoming intense. And in April of 2011, that RSI got up to 90. And the only other time in that history of the silver-gold ratio that it got up to 90 was in January of 1980 at that peak. So in April of 2011, we advised that the RSI was up to 90, that this was dangerous territory, and that a bear market would follow. So this, of course, was the case. And it was silver, the action in silver, that really drives the RSI up. So that was at 90, and then with the crash into March, the silver-gold ratio, the RSI got down to 11, which was as close to being dead opposite as you can get on the excesses reached in 2011. And of course, we put that out. This was effectively a secular buy on the gold sector. So the silver bugs are amazing, but silver itself and its behavior relative to gold is a very important indicator. There's one more step we're going to take with this, Jim, is that to flip now to the gold-silver ratio, which is it's looked at, is that when the gold-silver ratio is going down, it is within a general boom going on, conditions are expanding, all that sort of stuff. And then when the gold-silver ratio goes up, it signals a possible contraction. So this is where in December, when it was trading at 87, we noted that was the gold-silver ratio. We noted that if it broke up above 87, it would be indicating a financial problem possible. And in which case, if there was a financial problem, it would go as high as 115, and it went to 127, which shocked everybody. But no, the gold-silver ratio goes up in a credit contraction.
Overall, how is the second half of 2020 shaping up for gold?
The rally from our buy signal has been terrific for the metal and also for gold stocks. And the action in gold stocks recently is becoming overbought. And also the action in the big New York Stock Exchange, the S&P and the Dow, becoming overbought, and we are focused on the old saying, sell in May and go away. But Jim, often on buoyancy into May, May can have 6 or 8 weeks. Give us ourselves some elbow room here whereby the big stock market and the gold stocks are working on what could be a tradable top. And we'll be monitoring it with our special technical stuff. So the second half of the year may not be buoyant for many sectors in the stock market, certainly in lower grade credit markets like junk bonds could be another disaster. So, but let's look at the joy now and find the exit points for the broad stock market. And what we're advising is for our subscribers is that if you're a veteran trader, you can take some money off the table on some of our signals. But for investors, we would just remain long and buy the dips. And on the general stock market, our view since December, January has been to sell the rallies and not buy the dips unless you're a very skilled trader. So opposite action, Jim. The orthodox side of the investment world, which is stocks and bonds, are precarious, and the gold side is in a lengthy bull market.
Bob, thank you so much for chatting with us.
Jim, and it was so good of you to put together these questions. They were all very pertinent.
You can thank my executive producer, Tom Allen.
Okay. Good questions, and we look forward to getting together next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Charts and Markets.com. If you have any questions for Bob or any of our other guests, you can send them to info@howestreet.com. I'm Jim Goddard. Thank you for listening. Comments made on goldradio.fm are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at howestreet.com, talkdigitalnetwork.com. goldradio.fm is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.